In 2008, the global financial system nearly collapsed. The economic damage was staggering. The stock market lost a colossal $7 trillion. Millions of people lost their homes, their life savings, and their sense of security. But what was the true underlying economic cause of this disaster? It wasn't one single mistake. It was a catastrophic convergence of policy failures, reckless banking, and a fundamental misunderstanding of risk. Today, we're breaking down the complex, yet critical, economic cause behind the 2008 financial crisis. Let's start our journey in 2004. Interest rates, set by the Federal Reserve, were at historic lows, hovering at a mere 1.25%. This created an environment where borrowing money was incredibly cheap, fueling a massive housing boom. This was the era of easy money. In the feverish pursuit of greater profits, major banks started radically lowering their lending standards. They issued mortgages to individuals with poor credit histories and unstable incomes, people who would have traditionally been denied a loan. These loans were correctly labeled subprime because the probability of default was inherently high. This was the first critical crack in the foundation, extending massive credit to borrowers who were highly likely to fail. Here is where the financial system took a turn toward the dangerously complex. Banks didn't hold on to these risky subprime mortgages. Instead, they performed a kind of financial alchemy. They packaged thousands of these loans together into complex investment products called mortgage-backed securities, MBS. Crucially, these MBSs were then sliced into smaller pieces and sold to institutional investors globally, pension funds, insurance companies, and other banks. Rating agencies, which are supposed to be the market's referees, often gave these complex securities the highest possible rating, AAA, falsely labeling them as safe investments. The entire world financial system was unknowingly investing in a massive pile of toxic, interconnected debt, all based on the false premise that U.S. housing prices would never fall. By 2006, the housing market peaked and prices started their inevitable decline. This triggered a devastating chain reaction. Homeowners whose adjustable-rate mortgages reset to higher payments suddenly found themselves in a crisis. They now owed more on their mortgage than their home was worth, eliminating any financial incentive to keep paying. Defaults began increasing at an alarming rate. The initial alarms were sounded in April 2007, when New Century Financial, one of the largest subprime mortgage lenders in the U.S., filed for bankruptcy. This was the first major red flag. The crisis quickly spread to major investment banks. In March 2008, the massive investment bank Bear Stearns collapsed. It was acquired by J.P. Morgan Chase for a mere $2 per share. Just 6 months prior, those same shares had traded for over $170. The true climax arrived on September 15, 2008, when Lehman Brothers, a 158-year-old pillar of Wall Street, filed for bankruptcy. This was the largest bankruptcy in U.S. history. The event signaled that the government would not bail out every firm, causing the entire global financial system to freeze. Banks stopped lending to each other because trust, the foundation of finance, had evaporated. So what was the real economic cause? The disaster was the result of a triple failure: excessive risk-taking and speculation, a reckless pursuit of massive short-term profits by financial institutions based on the speculative and ultimately false assumption of ever-rising housing prices. Regulatory failure. Existing regulatory structures failed to monitor, much less restrain, the creation and global distribution of these complex, risky assets. The rules weren't strong enough, or the regulators weren't watching closely enough. Global interconnectedness. The design of modern finance meant that the failure of one major player, like Lehman Brothers, immediately poisoned the assets of countless others worldwide, triggering a rapid, system-wide global collapse. The U.S. government was forced to intervene with the TARP program, injecting $700 billion to bail out the largest banks and stabilize the system. But this was merely a temporary fix. The 2008 financial crisis serves as a stark reminder of the dangers inherent in a loosely regulated, interconnected global economy. It proved that systemic risk, the danger that one failure triggers an entire system collapse, is real and devastating. The nearly fatal flaw was not the subprime loan itself, but the way institutions obscured, rated, and distributed that risk across the globe. Understanding this mechanism, the cheap credit, the toxic packaging, and the global domino effect, is essential. It helps us recognize similar speculative patterns in markets today, ensuring we are better prepared to prevent the next crisis before it ever begins. If you found this breakdown valuable, hit the like button and subscribe for more deep dives into complex economic events.